In this short video, we will discuss diversification. We will first define asset diversification and then discuss how to create a diversified portfolio. We will touch on the process of diversification within an asset class and how that helps minimize risk within the capital markets. Diversification of a portfolio means reducing the risk in the portfolio by investing in a variety of assets. If the asset values are not highly correlated, a diversified portfolio will have less risk than the average risk of its constituent assets, and often less risk than the least risky of the constituents. Assets and stocks that are highly correlated move in tandem with each other. Highly correlated stocks move in the same direction over a period of time, which makes them subject to large adverse movements. When a portfolio is undiversified, it can sustain large losses over a small period of time. An example of an undiversified portfolio is to hold one stock. This is very risky, as it is not unusual for a single stock to go down 50 or 100% within 1 year. It is much less common for a portfolio of 20 stocks to go down that much, or even if they are selected at random. If the stocks are selected from a variety of sectors and company sizes, the chances of large losses are much less than the chance of losing a lot with an undiversified portfolio. A diversified portfolio should be diversified at two levels: between asset categories and within asset categories. So in addition to allocating your investment among stocks, bonds, cash, and possibly other asset categories, you will also need to spread your investment within each asset category. The key is to identify investments in segments of each asset category that may perform differently under different market conditions. One way to diversify your investments within an asset category is to identify and invest in a wide range of sectors. The stock portion of your investment portfolio wouldn't be diversified, for example, if you only invest in one or two stocks in the same sector. You will need at least a dozen selected individual stocks to truly be diversified, and those stocks will need to be in multiple sectors. Alternatively, investors can invest in exchange-traded funds that are category specific. For example, you can invest in an ETF that focuses on consumer staples, or technology, or financials, or industrials, or even consumer discretionary. Because achieving diversification can be so challenging, some investors may find it easier to diversify within each category through the ownership of mutual funds rather than through individual investments from each asset categories. A mutual fund is a company that pools money from investors and invests in stocks, bonds, or other financial instruments. Mutual funds make it easy for investors to own a small portion of many different types of investments. The concept of the capital asset pricing model introduced the theories behind diversifiable and non-diversifiable risk. Synonyms for diversifiable risk are unsystematic risk and security-specific risk, such as one stock. Synonyms for non-diversifiable risk are systematic risk, or the beta of the market, or market risk in general. If an investor buys all the stocks in the S&P 500, it is obviously exposed to movements in that index. If the investor buys a single stock in the S&P 500, he is exposed both to the index movements and the movements of the stock based on the underlying company. The first risk is non-diversifiable because it exists however many S&P 500 stocks are bought. The second risk is diversifiable because it can be reduced by diversifying among different stocks. There are a vast array of investment products that are available today, including stocks, stock mutual funds, corporate bonds, municipal bonds, bond mutual funds, life cycle funds, ETFs, money markets, and even treasury securities and cash. For many financial goals, investing in a mix of stocks, bonds, and cash would be a solid asset allocation strategy. Other asset categories that exist for a diversification process include real estate, precious metals, and other commodities, along with private equities and hedge funds, which are alternative investments. Some investors may include these asset categories within their portfolio to achieve diversification. Diversification is one of the best ways investors can mitigate portfolio risk while continuing to have upside performance in line with that investor's long-term goals.